Hi, Lee Thurburn here, and I want to welcome you to another episode of Live Stream Lee. We meet every day, Monday through Friday at 3 o'clock here on LinkedIn and YouTube, Facebook, and Twitter. So we're doing a live stream. Today I have a guest that's going to be joining us. Dustin Miles will be tuning in here in the next few minutes, and he'll be coming live in the second half. But yesterday I had a technical snafu, and so I'm actually redoing the live stream that I did yesterday, and there's a good reason for it. Number one, because the technical details or the technical glitch yesterday, I didn't get a live stream, and then at least not on time. And then the second is because I think it's an important topic, and it actually is incredibly timely because I just saw that the U.S. Congress has passed a $1.9 trillion COVID relief package. Well, that's what they call it, a COVID relief package. Actually, only about 9% of it's for COVID. The rest of it's for bailing out blue states and all that kind of stuff. Now, this isn't a political conversation as much as it is a money supply conversation. And so what I want to do is I want to give a little historical perspective and talk about some things that over my life I've observed relative to devaluations and the effect that that's had on the economy. Before I do that, I want to invite you to tune in to and join our community. Please go to livestreamlee.com and click on the Join My Community link and become part of our community. And I periodically post information in the community that area where you can get a hold of it that I think you'll find interesting, slides and other data, forms, stuff that'll help you with your business. I see Dustin has joined us in the waiting room, so we'll get to him in a few minutes. But before I bring Dustin on, I want to talk about devaluation. I remember waking up on Monday morning, January 19th, 1994. And for me, in my little world at that point in time, overnight, the landscape changed. As it turns out, the Mexican government, I think the president was primarily responsible, but the Mexican government devalued the peso, literally cut the value of the peso in half. Now, that was important to me because at that point in time, I was selling information to U.S. companies about how to do business in Mexico with Mexican companies. I had published a magazine and I had written a book, and I had a nice little magazine publication and information sales business. And my audience was companies in the United States that wanted to sell products to Mexican companies as a result of the newly enacted NAFTA a year or two prior. And what happened when Mexico devalued the peso, my business went away because nobody in the United States could sell anything to anybody in Mexico. See, what happened on that Monday morning, December 19th of 1994, is that Mexicans woke up and things that used to cost them 100 pesos from the United States cost them 200 pesos overnight. Literally overnight, the price of things doubled that they bought from the United States. Now, it very quickly filtered down through the rest of the Mexican economy, but they immediately quit buying things from the United States because the price had doubled. The reason I mention that is because something else is similar to that's going on right now. Now, as a little bit of historical sort of background, back in 2000, I bought and owned and opened a couple of Quiznos franchises. And in 2000, Quiznos sandwiches, specifically the Italian classic sub sandwich, 8-inch, was $1.99. That was the standard price. I happened the other day to be in a Quiznos here in North Dallas, and I looked at the price of the sandwiches and was thinking back, and I was literally flabbergasted. The same sandwich that back in 2000, just 21 years ago, was only $2, $1.99, was going for $6.37. Now, when you think about it, the sandwich effectively is the same sandwich, but it's 320% more expensive 21 years later. Is the sandwich over 3 times better? Is it worth more than 3 times what it was back then? Of course not. It's a sandwich. Well, this is an indication of the lack or the decline in purchasing power of the dollar over the last 20 some odd years. So what are some of the major things that have occurred over the last 20 some odd years? Is this just the result of inflation? Is this the natural sort of order of things, or is there something else going on? Well, I would submit for your consideration that there's been a number of major events that have gone on in the last 20 years. You had the attack on the United States, 9/11, and then there's shortly thereafter a tremendous amount of stimulus money. The federal government wanted to basically make sure that everybody could afford to buy a home, so they pumped a lot of money into the economy. And then we had the savings and loans crisis because we had a bubble there, so we had to bail out financial institutions. Extremely loose money supply stayed in place pretty much all through not just the Bush administration, but the Obama administration, and really didn't change during the Trump administration. And except for last year, we had COVID hit. And last year, we began to stimulate the U.S. economy. And as a result of stimulating the U.S. economy, as of today, there will be a total of about, well, including the 1.9 trillion that was passed today, a total of almost $6 trillion pumped into the U.S. economy between last year and what's happening right now. Now, I want to give you another interesting factoid, if you will. Back in 2000, now I have my little slide here, says that the average Texas home in 2000 was $132,000. That, I made a mistake. That's actually the average price, the home price of a home in the United States in 2000 was $132,000. Now, in 2021, it's right at a little over $300,000. So we've seen a 230% increase in the price of single-family homes in the last 21 years. Is the home you're getting bigger and better or not? Maybe a little bit of feature creep and size creep has occurred. But bottom line is if you bought a home 20 years ago and you wanted to sell it now, yeah, you'd get probably more than double what you paid for the home, but you wouldn't be able to buy any more home. And so what that means is that the value of the real estate didn't actually go up except in terms of the relative dollars, meaning you need more dollars to buy the same exact property. It's kind of like the submarine sandwich, only a little different example. And, you know, people talk about real estate being a hedge against inflation, but what is a hedge against inflation? Does that just mean you keep up with it? I mean, you think about it. If you buy a home, you keep it for 20 years, you've got it paid off, and then you want to retire, you'd like to think that you're getting ahead of the game. But really, are you? If all you can do is sell your home and go buy another one that's equivalent? I've got a friend that is thinking about selling her home and moving about 100 miles outside of Dallas, because you have to go that far outside of Dallas when you sell a $300,000 or $400,000 home to be able to get a little more land and a nice house and actually lower your costs and keep or upgrade your lifestyle. You can't do it in the same area. So is real estate really a hedge against inflation, or does it kind of just keep up? I mean, I think of a hedge as a buttress, a barrier of some sort of a fortress, but really, I don't know that you can claim that. Now, I want to give you another fact before I show you a graphic that's kind of alarming. A year ago, I actually hire developers outside the United States to do software development. And a year ago, this is therefore something that I'm pretty familiar with. A year ago, when you pay somebody in Europe in dollars, they get euros. And when you, back in February of last year, the exchange rate was 0.8672 euro to the dollar. Now, they're not the same as pennies and dollars, but basically you get 87 cents in euros for euro dollars relative to $1 United States. That was a year ago. Now, today, you get 80 80.5 cents, 80.467 cents. Basically, the value of the US dollar in the last year relative to the euro has gone down by over 7%. Now, on a daily basis, fluctuations go up and down, and you can't really look at macroeconomic trends on a daily basis, but a year is a borderline long enough time frame for you to say, what happened in the last year? Well, what happened in the last year is pretty obvious. The United States has pumped an incredible amount of money, about 4 trillion, into the US economy as a buttress or bulwarking against the negative impact of COVID. Well, what does that mean? Well, that means that in the last year, we've pumped so much money into our economy to help our economy out that our dollar has declined. Well, why has the dollar declined in value? Well, it's basically we're printing dollars. We're like having that printing press just running. Now it's actually not a printing press anymore because money is all electronic. It's computerized ledger entries and things like that. But we're basically just printing money like crazy and pumping it into the economy. And as you do that, what happens is you flood the economy with capital, with money. Where does it end up? For the most part, it ends up in the stock market, at least kind of in the short term, and then it filters out into other things that it can do, because money by itself isn't really valuable. It's what it can do for you. But what I'm pointing out here is that in the last year, when we pumped $4 trillion in, we saw a 7% decline in the value of the US dollar. We're pumping another 2 trillion in. Who knows what will happen over the next 6 months or 12 months in terms of the government deciding to pump more money in. I personally think that in the next 12 to 24 months, the cumulative impact of the 4 trillion plus the 2 trillion is going to cause our dollar to decline in value relative to the euro and other currencies by at least another 5, maybe 7 to 10%. I think there's a real good probability that in the next 12 to 24 months, you're going to see a total decline in the value for the last 12 months and the next 12 to 24, a total decline in value approaching 20%, maybe even higher. Now, what does that mean? Well, it's kind of like that event on January or December 19th when I woke up and overnight the peso had gone up in value. People quit buying American goods in Mexico because they were so expensive. European goods, European labor is already, and most foreign goods and most foreign labor is already becoming more expensive for people in the United States to purchase, which has a trickle-down impact on our ability to afford things. And those, whether you're buying a Mercedes that's built in Germany and shipped over here, or you're buying cheap goods built in Japan or China and shipped over here. And by the way, they're not all cheap. Some of them are great, at least in Japan. I won't say that much for China. Bottom line is our prices are going to go up, which means as business people, we're going to have to pay more and we're going to have to charge more, because the money, the dollars that we're collecting are not worth as much as they were. There's one interesting segment of the economy, however, that Dustin's going to enjoy talking about, I know, which is how income producing property is in fact a powerful hedge against inflation. Before I bring Dustin on, I want to show you one slide. This is a picture of Germany in 1923, some German city, and you have people with wagon loads of Deutschmarks, and they're taking them down to try to buy bread and or turn them into some other currency, I think metal, like gold and silver, to be able to forestall the impact of rampant hyperinflation. Now, I'm not sitting here telling you that the US dollar is going to become worthless like the Deutschmark did back in 1923, which, by the way, was a major contributing factor to the rise of Hitler. It was tremendous social implications when you have hyperinflation and devaluation of the dominant fiat currency. But we're headed down a path with all this stimulus money that we're producing and pumping into the economy, maybe not to be quite as bad as the picture on screen, but maybe way too close to that. Now, let's talk about commercial income producing real estate. I'm going to ask my friend Dustin Miles to come on and join us, and I want to introduce Dustin. Dustin is the founder and managing partner of a business called Momentum Multifamily. And Dustin is in basically the multifamily property investing business. And he's based out of Fort Worth, Texas. And I'm going to go ahead and take his picture down and bring Dustin in. Dustin, can you hear me?
Yes, I can. Yeah, thanks for having me. I appreciate that.
Well, you're welcome, and I'm tickled that you could join us today. And as I was preparing this little presentation, and I was thinking about how income producing property works, it's different than personal residential property. Personal residential property, if I buy, say, a $400,000 home and keep it for 20 years, and maybe it's worth $800,000 in 20 years, which is a realistic probability. And I sell that home and I want to go get another one. I can't get anything better than the one I've got because I'm paying for, I've paid for a home. I still have the same home, and all the other homes have gone up in concert. But I'm paying for that home with ever cheaper dollars. So the dollars that I'm paying in the future for my house, I'm actually paying less than you think you are because the dollars are worth less. But with income producing property, something interesting happens. If you've ever lived in an apartment, you know that about every year your rent goes up by 5% or 2 or 3%. So over the next 20 years, your rent, the income that you're earning on that property is significantly greater. You're not just locked into paying what you started. So that's an interesting dynamic that I'll bet you've thought about, haven't you?
Yes, yeah, absolutely. Yeah, it's been a great business, and not only do rental rates and lease rates go up over time, but they're also helping to pay off the mortgage as well. So there's kind of that dynamic spread, which is interesting, and which part of the reason why people are wanting to get into it. And then there's also tax benefits as well.
So when you look at, talk to me a little bit about I talked for quite a while about the impact of all this money we're pumping into the economy. Do you have anything to add? Do you agree? Do you disagree? What are your thoughts about what we're doing with all this stimulus money we're putting in? Is it good for your business?
I think it's, I was listening to you, and I think you said that the dollar may, I guess, devalue by 20%. I don't, I don't have a degree in macroeconomics, so I don't know if I can make a educated comment on that. But I think you were talking about real estate being a hedge and all that, and that's part of the reason why people are interested in investing in this industry. It's and one thing I want to point out that COVID really highlighted is people really got back to basics when COVID hit. People didn't necessarily need fancy cars, although I'm sure people went out and bought them and all that, but really got down to the basics of food, water, and shelter, and multifamily fits that shelter bucket. And then, we're investing in Texas. As you mentioned, I'm in Fort Worth, DFW, which is over the past 10 years has been the fastest growing metro in the US. And that trend is going to continue over the next 10 years, followed by Houston at number 2. So, you mix in, inflation or potential inflation rates going up, and you mix in, 1 million people coming in over the next year. Good things are going to happen.
So let's focus on the leveraging impact and power of real estate. I know you recently bought a $27 million property down in Houston. And over the next, whatever, you probably put, I'm guessing, like a 30-year note on it or something, some reasonably long note. But you're obviously going to be able to pay that back. You'll probably not own it for that long. You'll probably sell it at some point. That's kind of typically what I think your industry does. But you'll be paying for it with less expensive dollars as your rent revenues increase. What kind of returns Can people expect when they invest in Class A prime properties like you do, what kind of returns can they expect over the lifespan of, say, 5 or 10 years of a real estate investment? Are they going to do significantly better than the rate of inflation?
Yes, they will. And short answer, but typically what we're seeing right now is, and I'm giving a range. We're seeing, and we model everything on a 5-year hold. There's some people that do 5 years, some people do 6 or 7, some people do 10, but we do 5. And so typically right now you're going to see, anywhere between a 70 and 100% return, over 5 years. And that's kind of what we're seeing right now. That's a total return. That's assuming you sell the property at the end of year 5. And then in terms of, there's, cash flow that occurs, throughout the life of the deal, and that's included in that total return. But cash flow we're seeing, typically around 8% or so. Could be a little bit less, could be a little bit more, but that's what we're seeing. And then, what's not accounted for that is there's also tax benefits that are above and beyond that. And and frankly, there's some, we have some high income and some high net worth folks that they're mainly interested in the tax benefits. The rate of return is just more icing on the cake for them. They just want, it's a way for, there's a lot of tax advantages, especially right now with cost segregation and accelerating the depreciation, and that helps out quite a bit, and can help out, especially the high income folks.
So, how long have you been in the real estate market as an investor? What was your first deal that you did as an investor, and how did you grow to where you're at now?
I started in the single family space. I started about, I think I bought my first deal about 12 years ago, and single family residences, a rental. I did about half a dozen of those, and always had the eye of going bigger. And so met some folks that were in the apartment space, and kind of learned from there. I invested passively in a few deals. One was in Wiley near Plano. Invested in that almost 10 years ago, and then invested in some other deals before putting my own, it's called syndication, putting my own deal together. So put my own deal together, starting first deal in 2014, and have done over 11 of them to date. Total value of the properties is it's a little over 100 million, and so it's been an interesting game. Obviously we're want to make sure we do treat our investors well, and all that, and fortunately, it's helped that the real estate market's gone up as much as it has the past few years. But we also focus a lot on giving back to the residents. So if in my opinion, you take care of your investors, take care of your residents, and everything else just kind of falls into place. So we do fun things for the residents. We'll do, it's harder right now with COVID and all that, but before COVID, we do pool parties, pizza parties, Easter egg hunts, stuff around Halloween and Christmas and all that. So just trying to do fun stuff for the kids. Some of the complexes that we have purchased are in more working class settings, and so sometimes there's not a whole lot of disposable income. So that could be, some of these parties could be a huge thing for some folks. So so it's a win for them. It's a win for us, win for our investors. It's a feel good business, and so yeah, it's a lot of fun.
So 12 years ago, your first deal, what was the total value of that deal?
So it was single family. I bought it for $90,000, and I forgot exactly what it was worth. It's probably worth 130 to 150. And then I did, another 5 after that. And so most of those homes were in that. Actually, I bought one deal for 29,000. It was it was rough. But yeah, did some other homes and ended up selling those. And then the first complex that I purchased for I think 4.175. I was over in near Fort Worth, over in Haltom City, and put together almost 1.7 in equity. And so yeah, it's good. We held that for about 5 years.
So have you got your eyes set on the next deal yet, or are you still kind of looking around for it?
We're looking. We're looking, the deal size we're looking at is between 20 and about 45 million is where we're looking at. And then so yeah, and we're looking in all the major markets, Dallas, Fort Worth, Austin, San Antonio, and Houston.
Okay. So and what is your deal flow rate? I mean, obviously you're bumping up. You were at 20, 26 or 7, and now you're looking in the 30 to 40 range. Are you still kind of at a deal a year, or are you looking to do a little bit more frequent? I mean, are you kind of at the stage yet where you can handle multiple deals on an annual basis, or are you still kind of getting that part of your process and machine in gear?
Yeah, I would say right now, so our goal is to do 2 to 3 more per year this year. So yeah, we're looking to add more. We have a great team, lots of great folks around us, and this is truly a team sport. It's you can't, even if you have a lot of money and all that, there's just so many moving parts, so much going on that you really got to have a really good team around you.
So if somebody wanted to participate with you, I mean, obviously to invest in income property, they could do what you did. They could go buy a single family home or 2 or 3 of those and accumulate and manage themselves, or they could come in as partner / investor in one of your deals. What does that look like to get involved with you? Can you give any threshold levels of kind of what would be needed?
Yeah. So we on this last deal, we were able to accept accredited and non-accredited folks, and so to be accredited, you have to hit certain income or net worth levels. Typically, I'm trying to remember exactly. I think it's, if you're single, 200K per year. If you're married, I think it's 300K per year. Or the net worth $1 million without your personal residence. So that's the kind of the definition. There's some other things in there too, and then so our stated minimum was 50K on this last deal. We did have some people that were in as low as 25K, but we had between 25K and about 250 to 300K, so kind of in that range. And then yeah, if they have an interest, or always happy to help and kind of pay it forward. I had a lot of people that helped me along the way, so always happy to kind of pass that on and do the same. They can always go to momentummultifamily.com and click on invest, and that's a way to kind of see our deals coming up, or able to go through the website and just kind of contact us that way, and we can set the phone call.
I hope I'm getting this right. I'm going to turn a ticker on and save and then show. So there we go. Momentum Multifamily across the bottom. momentummultifamily.com. We are just about out of time, so I'm going to say thank you, Dustin. I really appreciate you coming on. And even though you weren't willing to go out there and make a state, plant a flag on a 20% devaluation in the next couple of years, but I get it. My only thing on that is I think we're going to see a significant devaluation, and I'm thinking it's going to be much bigger than most people would like to see when they look back on it. But
yeah.
It's just the way of the world. We're printing money like it's free, and we may continue doing that.
Nothing's free. Nothing's free. So
nothing's free. Nothing's free except for advice, right?
Yeah, yeah.
All right.
So,
Well, folks, if you're interested, go to momentummultifamily.com, give Dustin a call. He'll be glad to visit with you. I am telling you right now, the only way you can really get a powerful hedge against inflation, it isn't real estate, it's income producing real estate. And Dustin can help you out. Dustin, thanks for joining us. I'm going to pop you into the waiting room here, and I'm going to go ahead and put a little placard back up. If you are not already a member of our community, please go to livestreamlee.com and click on the Join My Community, and you'll be able to get Dustin's information and be able to reach out to him. I'll make it easy for you. Thanks for joining us today, and we'll be back tomorrow with another segment. Tomorrow we'll be talking about the value chain. And I think that you'll find that an interesting conversation as well. Totally different, but also very interesting. Thanks for joining today. See you tomorrow.